Hello. So I have an accounting one class that I'm teaching right now, and I wanted to just post a short video on kind of like an intro to accounting. I'll make sure in the comments of this video, I will give credit to the textbook that I used in constructing this PowerPoint. It's one I no longer use, but it's a very good intro to intro to accounting textbook. So I'm going to start off with the fundamental accounting equation. So the fundamental accounting equation is assets equals liability plus owner equity. I'm going to explain each one of those in detail. So what are assets? Assets are all the properties of value owned by a business. You have tangible assets and you have intangibles. I'm only going to be talking about tangibles. Intangibles are, ones that you can't actually touch and feel or sell, where someone picks up a product. That would be like your copyrights, your trademarks, your logos. I'm going to be talking about tangible assets. So assets are anything that are properties of value, like cash, your checking account, your credit cards, your savings accounts, your money markets, and so on. Supplies, equipment, your computer, your debt, anything that you purchase for your business to run. And then in our fundamental accounting equations, assets would equal liability plus owner equity. And liabilities and owner equity then would be any rights or financial claims to those assets. All right, so here's the fundamental accounting equations kind of looked at in that concept. Assets are anything owned by the business, equal equities, and those are all the total claims against those assets, or anyone who says they have rights to ownership of those assets. And so that obviously would be the business owner themselves, as well as any creditors that you borrowed from. So here's a list of assets. So cash, and this would be in order of liquidities, cash being the most liquid because it is money. But when we say cash, we also mean your checking account, your savings account, your money market account, credit cards. Obviously, credit cards you deal with differently, but I've had several different clients that have dealt with them several different ways, but you still look at them as cash when you're using them, versus if you use a credit card, you don't look at it as a accounts payable, you look at it as a cash account. Then you have accounts receivable. That's when you're selling on account, meaning you have a client or customer that you will be billing for a service or a product. So I like to use an example that I own a bakery. I call it G3 Bakery. So for the bakery that I own, I might have a customer like Red Roof Inn, which I use that as an example because it's the hotel that's right next to the school I work at. And the Red Roof Inn called my bakery and asked, can you please do our breakfast buffets Monday through Friday? And I obliged. And then I decided, instead of asking for a cash payment every day, which would be weird with a customer setup like that, instead I would send them a bill. So then they become an on-account customer or credit customer for me, meaning they would have an accounts receivable account with me because I would be sending them a bill. And then when they pay it off, I would bring my account receivable balance with them down when they pay it off. What other assets you have? Equipment. For my bakery, I might have an oven or a mixer. Then you have computers. And nowadays, I put register here because nowadays a lot of registers are considered computers. They have computing capabilities that we didn't see back like in the 70s and earlier. You have supplies, and those could be, for my bakery, it could be bakery supplies, or if it was in my office of my business, it could be office supplies. And then I put here car or truck, because if I have a bakery, maybe I'm going to have a delivery truck. I put down here land because I wanted to talk about that for a second. Land has unlimited useful life, meaning that it usually appreciates in value because obviously as time goes by, things usually go up in price. So land is supposed to, by theory, appreciate in value. I know that isn't always the case in all examples, but it's not an asset that would be depreciated. However, land improvements could be depreciated, like fences, a parking lot, a pool, and so on. Because if you owned a complex that you rented and then you had a water fountain on there, or if you had a pool in the complex, that would maybe depreciate in time. Note, land should be recorded at the purchasing price. What does that mean? So when you buy a piece of land, there could be several different figures getting tied to it. So if I go to a real estate agent, I'm looking for a piece of land. He said, listen, I got a piece of land that's worth $200,000. It was appraised at $200,000, but I got a great deal for it. It's actually right now on the market at $120,000. So I purchased that at $120,000. And then when I go to look at the books on it, as far as my taxes, my tax assessment says it's worth $95,000. So I have all these numbers coming at me, but what do I put in my books? I put the purchasing price. So whatever I purchased it at is what I acknowledge the value of that land, not any other number that was thrown at me. and then buildings. So these are just examples of assets. Obviously, most businesses, other than maybe very small businesses, most businesses have hundreds of assets that they list, and it all depends on how accurate you want to label each one of your assets. But again, assets are properties and things that you purchase to run your business, that you purchase that is owned by the business, and it has to all be labeled in different accounts. Liabilities, those are obligations that come due in the future. So usually it's some sort of creditor. For my bakery accounting class, I often use Pillsbury. I don't know why, but that's just the first one that comes to my mind. So let's say I want to get started and I'm buying flour and chocolate chips and sugar and baking soda and so on. I go to Pillsbury.com and they extend me a credit line. So I'm able to purchase everything and then I have about 30 days to pay it back. That would therefore be my creditor. Okay, so I would be purchasing something from this company and I would owe that company in the near future. Okay, so there's different type of liability accounts. You have accounts payable, and that's purchasing items on account like I just used with the Pillsbury account. Then you could have mortgage payable or loan payable. Those would be going to a bank and saying, listen, I would like to borrow some money in order to purchase a building or in order to expand and build another store, if I may. That's what I'm looking for. And it doesn't even have to be that, you might be just doing a loan that they'll base just off your business credit, but whatever it may be, you usually put that in a different account if you're going directly to a bank and getting a loan that you would be paying off in more than a year. So accounts payable with my clients, I usually say it's 12 months or less. If it's more than 12 months, then it would probably be a loan payable, and then you would put that under this type of liability account. And then this other one, this fourth one, I just mentioned because it is a liability account that you would use if you choose to do your accounting on an accrued basis. Wages owed, or wages earned. It's a liability account that is opened up, usually, let's say at the end of the month, if you're doing your bookkeeping on a monthly basis. And the example I have for this class is March 2021. And the very last week in March is March 29th to April 2nd. So there's 2 days, that Thursday and the Friday, that go into April accounting period. The Monday, Tuesday, and Wednesday of that last week in March go into the March accounting period if you do your accounting on a monthly basis. And so in accrued accounting, you have to allocate all expenses to this specific month that they were incurred. So for that last week in March, they're actually getting the paycheck in April. So you're not paying them until April, but in March, you want to acknowledge the 29th, the 30th, and the 31st of that last week in March. So you would do what's called an adjusting entry at the end of the month to acknowledge those 3 days, and you would put the credit to wages owed, meaning you're saying, oh, I have this liability that I'm creating. You would debit that expense and then you would credit this liability, but it's not really a liability because it's not like you're calling up your employees and saying, hey, that last week in March, I'm paying you that in April. They already know that. So you're just creating this account so that you can put the monies in an account that you will later do a reverse entry and then put it in, because it's actually really going to get paid in April. But you want to acknowledge those 3 days in March for March. And so that's why you would use that account. I just give that as an example because I'm giving you examples of different liability accounts. But the one that you 99% of the time will be using in this class, and then also in business, would be accounts payable. And that's because you'd be purchasing things often, or even it doesn't even have to be purchasing. It could be, let's say, your light bill, your utility bill, your internet bill, RCN. That's what we use here in the local area. When you set up that account, they send you a bill in the mail. You receive the bill. You don't have to pay it that day. You usually pay it 20, 30 days from then. So you would put it into your QuickBooks or whatever computerized accounting software you're using as acknowledging the expense the day you get the bill. However, you wouldn't pay it until 20 or 30 days later. So that would be registered into your accounts payable account until you actually pay it, and then you would debit accounts payable and credit cash. All right, so let's go to the next one. So we looked at assets and we said cash, supplies, equipment, and so on. Now we're going to look at liabilities and equities further. So I had said your liabilities account would be, accounts payable would be the 30 days or less. And then you have loans payable, mortgage payable, and several others if you were looking beyond a year. And then the other one to our future obligations would be on our right hand, all the way on our right hand side of the equation, owner's equity, which you see here. And under owner equity, we have 4 main points of it. We have the capital account, which represents our owner's worth. We have our revenue, and that's anything that I am providing to my customers to sell, or if it's a service business, any services that I provide. So if I'm a lawyer, and that's with the book I was using prior, that I used for this PowerPoint, is they're a lawyer. So they provide services. They don't actually sell products. They provide services. So revenues are going to either be sales or services. That's how I usually use it when I present them. And then under capital and revenue, you have expenses and withdrawals. So notice how I have revenue in green. The reason why I have revenue in green is because revenue increases your capital's worth. I have expenses and withdrawals in red because they decrease your capital's worth. So when you have to pay your rent or pay your salaries or pay your telephone bill, or internet, or any of those expenses that incur on a monthly basis, that brings down the value of your capital on a monthly basis. Then you have your withdrawals. Withdrawals are any monies that the owners take out for personal use. So if I wrote a business check for my home mortgage for my bakery, that obviously would be a withdrawal because my home mortgage has nothing to do with the business. So I use this for personal use. I know some people stop me and say, well, what if you use your phone? I'm an independent contractor and I use my phone for work. Well, that's something that you would do at a later basis. You can deduct certain expenses if you can prove that you use that for work. Obviously with the IRS, we're talking about that. All right. Capital account. That is the owner's investment in the company. Obviously, for this example I'm using in this, I'm using a sole proprietor that's just starting their business. So this would be their initial investment. But as you continue and the business goes on, that capital account represents what worth that particular business owner has of the business. Now, mine is a sole proprietorship, but you might have a partnership where there's several partners. And so each capital account would represent what each of those owners have in the business. And they might not be equal. They might not be 50-50 partners, or they might take out more and put more into the business. And so therefore they have their own capital accounts that represent their investment in the business. It does not always mean cash, because I can start the business, let's say my bakery, with cash and an oven. I could be bringing in 10,000 cash, let's say, and a $5,000 oven with me from an earlier investment that tanked. And I decide I want to bring this over into my new business. So your initial investment doesn't mean it's all in cash. You would put whatever worth that you'd be able to prove that item that you're bringing in with you is, and then that would be added into your capital account, and you would be debiting whatever that asset is that you're bringing in. That includes any asset the owner can put into the business. For sole proprietorship, the capital account is also referred to as an equity account. So I know a lot of people might say, capital account when they're talking about the owners, or some people say your equity account. Just so you might hear me use both of those terms. So normally when you're dealing with transactions, two accounts are affected. So when I first introduced the concept of accounting, before we even get to debits and credits, which is the main language of accounting, I want to first talk about how are these accounts affected. So I want you to first identify the account under what I just spoke about. I spoke about assets, liabilities, and owner equity accounts. First, identify what kind of account it is, and then ask yourself what's happening to it. Is it increasing or decreasing in value with each transaction that I am going to introduce to you? So here I'm going to start with, I started a new business. It's called G-Tree Bakery. I started it with $25,000. Okay. So in this case, I took out a check from my personal banking account for $25,000. I went to Bank of America and I said, I want to start a commercial account because I'm opening up a bakery. And they said, oh, great, let's get started. I give them that check for $25,000. I now have my first transaction for my business. Two accounts were affected here: my capital account and my cash. So I would first want you to identify those accounts. So I have the asset, cash affected. And how is it affected? Cash is increasing by $25,000. And then I have the equity account, capital, is also increasing by $25,000. Okay. So again, we're not talking about debits or credits yet. First, I just want you to look at what accounts are affected. I purchased a delivery truck for $20,000 and I wrote a check. I didn't take a loan out for this. So remember, a check is considered cash. So I purchased a delivery truck for $20,000. What two accounts are affected here? So my asset, and I'm going to call it truck, will increase by $20,000 in value. Now I have an asset for this business and it's a vehicle. I'm deciding to call the asset truck. Pretty lame. And obviously you probably put Ford F-150 because you might have a fleet of trucks at one point. You might be specific with the year or the model or whatever you want to be. But again, this is very basic and simplistic introduction. So I'm just going to say truck. So my asset called truck increases by 20,000 and my asset cash decreases by 20,000 because I just wrote a check for $20,000, right? Again, we're not looking at debit and credit. I just want to see what account and how are they affected. I purchased an oven for $2,000. So I went to a restaurant supply store and I said, I'd like to buy your best oven. I'm opening up a bakery and they say, we have one on sale for $2,000. The asset oven would increase by $2,000. And if I paid $2,000, then the asset cash would decrease by $2,000. I purchased a computer on account for $1,000. So when I say on account, that means the store offered me a line of credit. So I went into Staples and I said, I need to buy a computer for my business. And they said, come on over here. You know, while we're talking, why don't you fill out this application right here and see if we can extend you a line of credit? Before the end of the purchase, they decided, yes, we can. And so I don't have to give them $1 that day. Instead, they're extending me a line of credit and I have 30 days to pay it off. The asset computer increases in value by 1,000. The asset accounts payable increases by 1,000. Cash was not involved here. Instead, I took out a short-term liability that I'm putting into the liability account, accounts payable, because I will pay that off within 30 days. I sell 3 dozen donuts. 3 dozen bagels. See where mine's at, where my mind is at. I sell 3 dozen bagels for $50. So my first day of business, I open up my store. I have a big sign, grand opening sale, and I sell 3 dozen bagels for $50. So my customer comes in, gives me $50 cash. I put it into my register. What happened? Well, my asset cash increases by $50 because I'm going to put that $50 into my bank account. And then the revenue account, which is that owner equity account, revenue, which I'm going to label sales, increases by $50, right? Because when you sell something, you're increasing your revenue. Or if it's a service business, when you provide services, you're increasing your revenue account. I sell 2 cakes on account for $40. So one of my neighbors in my complex comes over to me and says, I'm having a small birthday party for my secretary. I'd like to have 2 different birthday cakes for that day. Can I pick it up on Friday and pay you the following Friday? I said, no problem. Okay. So he comes and picks it up. I'm going to acknowledge that Friday, that sale, if I'm doing my accounting on an accrued basis. So my revenue account sales is going to increase by 40, correct? Because I decided to do my accounting on an accrued basis and I have to acknowledge my revenue that day, even though I didn't accept the cash that day. Instead, I'm billing them. So what account is that? When I bill a customer, that's the asset accounts receivable. The accounts receivable account would increase by 40 because I'm now establishing this accounts receivable customer and saying that they owe me $40. So in my QuickBook account, I'm going to show that I have $40 coming to me in the next week or 30 days. I pay my employee $300. So I hired a part-time employee to come and help me out because there's a couple of times during the day that I have to run errands. And at the end of the 2 weeks that they work for me, I now am going to give them $300, either cash or I write a check, whatever we feel comfortable with. So what 2 accounts are affected here? Well, I'm paying my employee. This is an expense that incurs from me running my business, correct? So the asset cash is going to decrease by 300 because I either gave them cash or wrote a check. So my bank account is going down in value by 300, and the expense, salaries expense, increases by 300 because I've now incurred the expense of 300 for hiring somebody and having to pay them for their services. Here's another example. So I have an attorney at law, Mia Wong, that just started a business, and she wants to invest in her business. So I'm giving you this example because I want you to be able to have some sort of visual for my visual owner, a visualization of what's going on with the accounting equation. So this is what you call the expanded accounting equation. And some books use it, some books do not. The one I'm currently using does not, the one I used to use does. So this will help those that do need that visual picture of things. And hopefully it'll help you along as opposed to just hearing me lecture. So Mia Wong invested $6,000 in cash and $200 of office equipment. So suppose she had a small laptop she'd like to bring in. She works for an accounting firm already, attorney firm already, but she'd like to start a small business on the side. So she starts with writing a check for $6,000 to Bank of America to create her commercial account. And she also has a $200 laptop. So what happens here? This is actually called a compound entry where we're affecting 3 accounts. We would say cash is increasing by $6,000, office equipment is increasing by $200, and Mia Wong capital is increasing by $6,200. $6,200. So we're establishing her capital account, her worth of the business at $6,200. On August 29th, the law practice bought office equipment for cash, $500. This is called a shift in asset because it's actually not changing the final number 6,200. Instead, I'm taking from one asset and giving to another. So I'm writing a check for $500, or I gave her cash for $500. So then I'm taking $500 out of my cash account, and I am now establishing more into my office equipment. So I purchased, let's say, a desk for $500. So my office equipment now is valued at $700, but my bank account is now at $5,500, but I still have $6,200. And so Mia Wong still owns $6,200 in this business. It's just that there was a shift in asset. Now she has $700 in office equipment and $5,500 in cash. Mia Wong buys additional office equipment, but this is on account at $300. She went to the same Staples I went to, and they offered her a line of credit. And she decided, okay, I'm not going to pay cash today. Instead, I am going to walk out with this printer that's worth $300, and I'll pay you at the end of the month. So now we have where equipment is going to increase by $300 and accounts payable, because we purchased it on account. Accounts payable will increase by $300. Now giving us $6,500 on the right side, because Mia Wong owns $6,200 of the business, but Staples now has some part ownership, as you may want to see it as, of $300, because you have that liability to Staples now for $300 that you need to pay. So they have kind of what you see as part ownership to these assets that the business owns. Okay. So I'm going to stop here and just introduce the concept of financial statements. So every business wants to run certain financial statements on a monthly basis to kind of get, a snapshot of how their business is doing, as well as get a good feel, am I in the green or am I in the red? Meaning, am I making a profit? Am I getting a net income or a net loss? You also want to look at trends in your business and so on. So one of the financial statements we'll be looking at is the balance sheet, and that shows the history of a company. It reports the financial position on a particular date. It actually gives you a snapshot of that fundamental accounting equation I just introduced you to, assets equals liability plus owner equity, because in this particular financial statement, you're going to see the ending balance of total assets, total liabilities, and total owner equity. This is what Mia Wong's balance sheet would look like at the end of her first month. So she just opened up at the end of August of whatever year it is. And right now her assets show that she has cash with $5,500 in it and office equipment with $1,000, and her total assets comes out to $6,500. We saw that also in our expanded equation chart. Now on the right-hand side, because this is a simplistic version of a balance sheet, normally they would be elongated and you would see it from top to bottom. You would see assets on top and then liabilities and owner equity on the bottom. But this is a small business, so they have this set up, where on the right-hand side you see liabilities, and the only liability so far that she has set up is accounts payable at $300, because remember she owes that Staples account. And then you have under owner equity, her capital account. And this represents what her worth of the business is, which is $6,200. And now her total liabilities and owner equity is $6,500. Now, somebody might be asking, do I really use the term accounts payable? Most definitely you do. But normally what you do is right after the accounts payable, you would put the different accounts. So this one actually would be accounts payable Staples. For me, I might have accounts payable Pillsbury, accounts payable Staples, accounts payable, and so on. So you would list your different customers after the term accounts payable. I'm sorry, not customers. You would list your different vendors or creditors after the account payable. So when preparing your balance sheet, you would have a heading on the top, and the heading contains the company's name, the name of the statements, which we know in this one is balance sheet. So for me, it would say G-Tree Bakery balance sheet, and then whatever date. The date normally would be the last day of the month, because that's when you do your final bookkeeping for the month, on the last day. So and the other thing you might want to note is that the use of the dollar sign would only be on the left hand of the top number and the bottom. But this would be done for you if you're using QuickBooks, which most of my clients don't do manual accounting anymore. They use QuickBooks. Oh, I'm sorry. I pushed that too fast. And let's go back real quick, because I do want to show you that you saw the dollar sign was on the top. and at the bottom, but all the figures that'll be in the middle, there's no need for a dollar sign. Again, if you use QuickBooks, that's something that they would put there for you. And then for Mia Wong, let's look at that. Mia Wong is attorney at law, balance sheet, and it has August 31st, the last day of the month, because she does her accounting on a monthly basis. Running objective 3 would be record transactions into the accounting equation. So now we're going to look at Mia Wong's next month of business. So we're going to look at a few more accounts here: revenue, expenses, and withdrawals. So revenue is the amount earned by performing services or selling goods to a customer. It increases your owner's equity, and it's recorded when it's earned if you're using the accrued basis. I have had clients that use the cash basis, and so that would be a little different because then you only acknowledge it when the cash is exchanged. But in this case, we're using an accrual basis for accounting, meaning once I brought that cake over to my neighbor in my shopping complex, I have to acknowledge the revenue, even though cash wasn't involved. I'm going to bill that customer, get the money later. So you acknowledge the expenses and the revenue when they're earned or incurred. Assets increase. So cash, if a client pays right away, you would increase your asset, but you would use accounts receivable if a client promises to pay in the future. So we're looking at revenue when we're talking about, which asset you're going to use. Expenses, those are costs incurred in efforts to create revenue. It decreases the owner's equity. It's recorded when it's incurred because we're using the accrued basis, and paid in cash or can be charged. We talk about the concept net income or net loss when we're looking on, obviously, if you're doing your accounting on a monthly basis, when we're looking at our revenue and expenses. So we would take revenue minus expenses, and it's either going to equal net income or net loss, or I guess in a very rare case, it might be a break even. But I've never seen a textbook that uses break even. If your revenue outweighs your expenses, then you would have a net income. You made money for that month. But with a lot of new business, you'll see the opposite usually in the beginning of your business. If your expenses, therefore, outweigh your revenue, you would have a net loss, and that would be a decrease to your equity account. And then withdrawals are any cash or assets removed from the business for personal expenses. That is a decrease to owner equity. It's not related to business. So my example that I use for G2 Bakery is I wrote a check for my mortgage payment. If I pay something from my business checking account for a personal use, that would be considered a withdrawal, and it is not an expense, but it is treated as an expense in that it also negates or decreases the value of your capital account. So let's look at the next transaction, which would be D for Mia Wong. For the month of September, now she does her revenue on a monthly basis, which is odd, but this is what she does. So on a monthly basis, for her cash sales, she did $2,000 of legal services for cash. And then this actually wouldn't be odd if it was a small business. I've had clients that have very small business. And as I said, Mia Wong has her own job, and then she has a side business. So this is a side business. And so on a monthly basis, she acknowledges her revenue. So for the month of September, she provided legal services for cash of $2,000. What two accounts are affected here? Cash and her revenue. So cash is going to increase by $2,000 because she's putting that $2,000 into the bank account. And her revenue increases by $2,000 because she generated money for her business. Now, for the month of September, she provided legal services on account for $3,000, which is very likely for a lawyer because lawyers usually ask for a retainer up front and then bill you later, especially if they know you. So in this case, we're billing the client. The client didn't give cash up front, so we provided the legal service and we sent them a bill of $3,000. So that means accounts receivable was increased by $3,000. No cash was involved here. We are billing them for $3,000. And then the revenue account increases by $3,000. For the month of September, she received a $900 cash check as a partial payment for previous services performed. So for that client that she provided the $3,000 worth of service, they mailed a check for $900 as their first payment. So when you first build that client, you acknowledge the revenue. After that, and they mail you a payment, you'll only be dealing with cash and accounts receivable at that point. You've already acknowledged the revenue for that. So instead, this is a billed customer sending you money. So you're going to take that $900 check and you're putting it in the bank account. So your cash is increasing by $900. But your accounts receivable account must go down $900 because they no longer owe you $3,000. Now they only owe you $2,100, correct? So this would be a shift in assets because they're paying you off from the invoice you sent them. So cash is increasing by 900 and accounts receivable is decreasing by 900. Also within that month, you paid salaries expense of $700. So if you paid somebody money, your cash is going down, correct? So your cash decreased by 700 and your expense account increased by 700. Now notice down here, you have an increase. Yes, cash increased. I'm sorry, expenses increased by 700. However, if you look at the fundamental accounting equation on the very top, remember I told you expenses and withdrawals were in red. They're actually negated because they bring down your capital, right? So you see withdrawals here and you see expenses here, they have negatives in front of them. So even though this is a positive expense, when you're actually calculating your ending, this is for people who are actually using this. My students that I have now are not, but if you do have to use the expanded accounting equation, just know at the end, you're subtracting all your expenses and withdrawals, okay? For the month of September, you paid rent of $400. So if you paid your landlord, that check is going to be deposited into his account and out of your account. So your cash is going down 400 and your expenses are going up 400. You incurred advertising expense of $200. You put an ad, let's say, in the local penny saver. So you didn't send them a check. You instead said, send me a bill. So this is now your creditor, the newspaper. So they're going to send you a bill that you now have to pay. You have 30 days to pay it off. You're paying it next month. So when you incurred that liability, your accounts payable goes up 200 because you didn't pay cash for that advertisement. You agreed to pay it in time. So your accounts payable goes up 200 and your expenses go up 200. However, remember, expenses are negative. So this would be a shift in equities because no asset was affected here, correct? Oh, I'm sorry. I pushed something. All right, the next one is Mia Wong withdrew $100 for personal use. So she took money out of the business account for personal use. So you're taking $100 out of your checking account. So cash goes down 100. And when it says personal use, you know that's going to be a withdrawal. So we're taking 100 and putting into our withdrawal account, which is a negative. So we took a negative out of cash. We brought withdrawals up 100, which eventually looks like a negative 100 to your capital account. So this is a snapshot of the expanded accounting equation in its totality for the months of August and September for Mia Wong. And I will, in my notes for this video, put the book that I used for that particular section of my PowerPoint in case you want to refer to that more in depth. So I'm going to look at 3 different financial statements, and the 3 financial statements 99% of accounting books first introduce you to are the income statement, the statement of owner equity, and the balance sheet. So the income statement shows a business's revenues and expenses for a monthly basis normally, but it says it can cover any period of time, whether it be monthly, quarterly, or yearly. But for most of my clients, we look at it on a monthly basis. So we're looking at our revenue and expenses for that month, and we're going to have a total at the bottom, which either gives me a net income or net loss. Because remember, I said, when you take revenue minus expenses, if the revenue outweighs your expenses, you'll have a net income, meaning you gained money for that month. But if your expenses outweighs your revenue, you would have a negative, which turns into a net loss, which would bring down your capital account. The top of your income statement, okay, would be the company name, the name of the statement, which is income statement. So for me, I'd write G-Tree Bakery income statement, and I would say for a period of time. Unlike the balance sheet, this would be for a period of time. So I've seen customers that have wrote for month ending or for the month of. So if it was for the month of September, you would say from month ended September 30th, or you might say for the month of September 2020, or some clients have actually written out September 1st, 2020 to September 30th, 2020, whatever you feel comfortable with. QuickBooks usually will have a standard, and I don't think people are too picky with it. In Mia Wong's case, she has for month ended September 30th and whatever year you're in. So we have Mia Wong, attorney at law, that's the name of her business, income statement, and for month ended. So these are the real numbers that we use from that example we just looked at. So her legal fees for this month of September were $5,000. Remember, she had $2,000 in cash and $3,000 for credit customers. Now we're going to look at all her expenses. She had salaries expense for $700, rent expense for $400, and advertising expense for $200. Note we have this left-hand column. What is this left-hand column for? It's in order for us to do some sort of computation. Now, I want to be able to list in my income statement, and you want to get a good visualization of what your business is. And in QuickBooks, it does this. It lists all your expenses, so you can look or drill in on a specific expense if you want to look at it further. So you're not looking at just the total of expenses. You want to look at each individual expense, and then you have to add them together. So that's why we have this left-hand column for those of you who use manual accounting, because this left-hand column will allow you to list them separately, and then you'll put a single line and then add all these numbers together to give you your total operating expense of $1,300. So great, Mia Wong made a net income because her expenses were less than her revenue. So we take the 5,000, subtract the 1,300. See this single line? That's denoting there's some sort of computation. I'm subtracting my expenses from my revenue to get my net income in this case, not a net loss because my revenue is greater, a net income of 3,700. Now I have the double lines letting me know this is the end of the particular section. I have a total. I've calculated some sort of total, and this is the end of my income statement, and my total is a net income of $3,700. The next statement we're going to look at is your statement of owner equity, okay? And that's increased by any owner's investment. Obviously, as you're a business, if you've been in business for years, there are times during the year where you might be increasing your investment by adding money into your business. So you can have additional investments into your business, right? And then it also is increased by net income. So as we saw, Mia Wong just had $3,700 of net income. So that's going to increase her capital. What is capital decreased by? Capital is decreased by withdrawals and a net loss. So if my revenue for Mia Wong was lower than my expenses, then she would have a net loss. So this is an example of the statement of owner equity for Mia Wong in September. So remember, she started the business with $6,200. This is her first month of business. So of actually, generating money. So she has her beginning capital as September 1st of $6,200. Then she has her net income. So that's increasing. They have it in blue here. So that means that's increasing her capital. But then we have to go less withdrawals. So we're taking away 100. And then she would have an increase of capital of 3,600. Why? We're taking 100 out of the 3,700 she gains. And so we're increasing her capital by 3,600. And now her capital at the end of September is worth 9,800. So she has 9,800 as the value of her capital account at the end of September because she made a net income. Now you see the two lines denoting we had a final computation. That's the end of this particular statement. Now, what if Mia Wong would have had a net loss? Okay, if she had a net loss, it would say less net loss for September and less withdrawals, and we would take a total negative of 500 from her capital account. The other thing the author wanted you to look at, what if she did additional investments? As I said, a lot of times as business continues, you might have, remember, Mia Wong is an attorney on her own. Maybe she had a bonus for that month and she decided, you know what, I want to put this into my side business. So I'm taking the $700 bonus and putting it right into my business. So you would consider that an additional investment, and you'd put the date in which you put that additional investment in there, and that would also increase the value of her capital account. So this would be a statement of owner equity with a net loss. As you see here, we'd be subtracting this net loss. We subtract a total of 500. And then this would also be a statement of owner equity if we had an additional investment, which we were just talking about a second ago. You would just add that in here and then showing her 6,900. So remember, she had originally 6,200, but we're saying, what if she did an additional investment? We would just add that here in the statement. So what have we looked at so far? We looked at an income statement, which is revenue minus expenses, and it ends either in a net income or net loss. And the second statement we're looking at is a statement of owner equity. I want you to note something. The first statement gave us a net income or net loss. And in both examples that we looked at in the statement, we have that number here. In this case, we have the net loss of 400, and I'm going to go back to show you the one that we actually are using in this example. She had a net income of 3,700. So this right here, see, this line says it comes from the income statement, which tells you have to do your income statement first, correct? So you do your income statement, you get that number, net income or net loss, and bring it into your second statement, which is the statement of owner equity. So first comes your income statement. The second comes your own statement of owner equity. And now the third one comes your balance sheet. This is the third of the four main financial statements. So here's my balance sheet for September for Mia Wong, attorney at law. Her assets are cash, accounts receivable, and office equipment. You can see that from expanded equation that I had presented earlier. And she has 10,300 here as her total assets. Now on the right-hand side, I have total liabilities, which are 500. Those are her account payables, which she owes. And then she has her capital account of 9,800. Where did this figure came from? This figure came from the ending capital from her statement of owner equity. That 9,800 was from the statement of owner equity we just completed on September 30th, the last day of the month. And that was our second financial statement. Again, we started with our income statement, then we did our statement of owner equity. And that last figure in statement of owner equity went into our balance sheet here. And now we have our assets, 10,300, equal our total liability and owner equity of 10,000. Oh, I'm sorry, 10,300. 10,300. Look like an 8 for here. All right, and here's just a quick snapshot of what goes where. On the income statement, you're going to see revenue and expenses. On the statement of owner equity, you're going to have your beginning capital balance, your ending capital balance, your withdrawals, and then what you don't see here is your net income or net loss. And then your balance sheet is going to be that fundamental accounting equation of assets, liability, and your capital, but it'd be your ending capital. Remember, you have to take it from your statement of owner equity. So therefore, your income statement is prepared first because you need a net income or net loss figure to go into the second one, which is your statement of owner equity. That's second. And your statement of owner equity is going to give you your ending balance, which then goes into your balance sheet, which is your last statement that you would be out of the three fundamental financial statements, which normally are in 99% of the accounting books that I've taught out of. Those are the first three financial statements they introduce. The income statement, the statement of owner equity, and the balance sheet. I just want to take a second before my QuickBook users. The income statement is actually your profit and loss statement from your QuickBooks. So most textbooks use the old term income statement. QuickBooks uses the term profit and loss. Okay. So they're showing here, the single line, double line, which I've already discussed, but let's reiterate. The single line means the number above it will either be added or subtracted. There'll be some sort of computation. So the single line is letting the reader know there's some sort of computation being done here with these numbers on top. And the double line indicates a total of some sort in this case, or the ending. I usually used to tell students a total or ending of a statement. Understanding the columns, I also mentioned this. On the left-hand side, if you have a column, that means that you're having some sort of computation done and then a total from that computation. So in this case, we have expenses and we have total expenses found in the right column. And on the left-hand column, this is a statement of owner equity where we're combining our net income and our withdrawals. And this would be our total of what's happening in capital. In this case, we're having an increase in capital. If we had a net loss, we would have a decrease in capital here on the right-hand side. All right, I'll throw this out. This is just a few questions that I ask my students. I'm only going to do one with you. If I had assets of 30,000 and owner equity of 22,000, what would be my liability? This is something that it wouldn't be as simplistic, the question, but the question might be written out as, New York Giants apparel had assets of the month, March, of 30,000. It was also noted that their owner's equity was 22,000. Therefore, what would be their total liability? And this would be an A equals B plus C situation where you would take assets, a minus owner equity would therefore give you your liability of 8,000. I will stop my video here. And I'll do a couple more of these videos for my students, as well as any small business owner that are just getting started and doing their own books and are not familiar with accounting. Hopefully some of you find these helpful. Okay, thank you for watching. Thank you.